Oh, yeah. But Andrew, yeah. I know it's gonna be. Oh, yeah, I got to stay.
Welcome everybody. This is the annual update of Eagle Fund, which is a student managed investment portfolio. My name is Brad Andrew, BA, as known to most people. And I've been the faculty overseer of the Eagle Fund for a dozen years or so now. I've kind of lost track. It's been a while. It's been a while. So we're going to turn it over to the portfolio management team. 6 out of 7 of them are here. One of them, Aaron Warren, couldn't make it today. So this is the team, and they will introduce themselves.
Thank you, BA. Good afternoon, everyone. Thank you for being here, and welcome to the Eagle Fund's annual Fall 21, Spring 22 annual update. Now, before we get started, we have to make a quick disclaimer that none of the advice in this presentation should be construed as investment advice. This is not investment advice. It's all educational material. And now to kick it off and get started, we, the portfolio managers of the Eagle Fund, are going to introduce ourselves. My name is Andrew Cerrone. I am a senior here studying finance.
I'm Sean Braden. I study politics and with a secondary of economics.
My name is Hunter. I'm a senior. I study biology with a secondary in investing.
Drew Mayers, senior studying finance.
I'm Brandon Ashers. I'm a senior studying business administration.
I'm Ryan Hughes. I'm a junior studying philosophy, politics, and economics with secondary in Spanish and environmental studies.
So today we're going to finish our introductions. We're also going to talk about the macro environment, also how the Eagle Fund is allocating its money, the strategies involved, also what we've changed in the past year to an update, as well as the overall performance of our fund compared to our benchmark.
Okay, so a little bit about the history of our fund. So the fund started with a $100,000 donation from the Lake Claire Sunderland. And since its inception 15 years ago, the portfolio has grown to over $250,000 in valuation. And that can largely be attributed to the increase in sophisticated strategies that we've implemented over time. It has offered us a great opportunity to learn about investing and all these different strategies that we talk about throughout the series of one credit portfolio management courses. And we're all very excited to be able to talk a little bit about how we've managed the fund over the past year.
Okay, we're going to jump into the macroeconomic conditions of the past year. So a lot of what we're seeing can be described as a consequence of COVID and the policies around it. Right now, supply chains are still incredibly stressed. They were stressed during COVID, there was a brief break, and now the issue is even worse than it was before. This right here is a picture of the port of Shanghai. If you're not familiar, Shanghai's been shut down now for several weeks. 23 million people are locked down. Those green dots represent cargo ships, the red dots represent tankers, and that's a lot of congestion, and you don't want to see that in a port. So the supply chains are stretched to their limits right now. And a lot of that has been exacerbated by demand coming back online. Personal consumption in the US has resumed its pre-pandemic trends and is actually rising. And you'll see a lot of that demand is actually for goods rather than services. New orders for manufacturing goods are up 13% year over year, while demand for services is down quite a bit, almost 10%.
When discussing the macro environment, macroeconomic conditions, it's important to note that the government wants to have some level of control and influence over what happens. And they do that primarily through monetary policy. So during COVID, we saw a lot of changes in monetary policy. The recession that resulted from the pandemic caused the treasury market to seize. We saw yields spike and prices drop. And the Fed responded very strong. They cut interest rates. The federal funds rate during the pandemic was 0 and 0.25%. They revived all of the global financial crisis lending programs from 2007. And they basically lent to anyone with a pulse. And with that also comes some changes in balance sheet policy. The Fed looked to expand their purchases of treasury securities and mortgage-backed securities. They expanded the treasury securities by about 80 billion per month in order to reduce yields there, and mortgage-backed securities by about 40. Similar to monetary policy, fiscal policy was also used during the pandemic to encourage economic growth and relief. Like I said, the federal government gave out money to just about anyone and everyone. In 2020, a $2.2 trillion economic stimulus bill, the CARES Act, was signed into law. And then in 2021, an additional 1.9 trillion in the form of the American Rescue Plan was signed in. So as you can see, the federal government just pumped a bunch of money into the economy to sort of stimulate the recovery. And it worked. It recovered very quickly. Unfortunately, as a result, the federal deficit was the highest it's ever been, as you can see on the graph here. Previously, the highest it had ever been was during World War II. And many cite the large generation and distribution of these funds as a primary reason for current inflation numbers.
So inflation's been a hot topic for a little bit now, and for good reason. All the things that we're seeing, supply chain disruptions, expansionary monetary policy, and generous government spending are all contributing to inflation. We started to see inflation pick up when the COVID recovery started, and originally people thought it was going to be transitory. They didn't think it was going to stick around. They thought it was going to fall back down. That has proved to not be the case. Inflation is sticking around. And we've seen inflation at levels we haven't seen since the 1970s, which is really interesting, because for the last 40 or 50 years, inflation has been in a stable, consistent downtrend. This isn't something people have had to worry about. And now with inflation, the last CPI print was at 8.5%. Investors are starting to question, how their portfolios are positioned. Now, how are they going to react to the inflation? How are their positions going to perform in an inflationary environment? So this is something investors haven't had to worry about for about 40, 50 years now, and it's scaring a lot of people. We've had some internal discussions along those lines as well.
So going back to monetary policy, it can either be expansionary or contractionary. Throughout COVID and pandemic, it was mostly expansionary, so we could facilitate economic growth and recover. That is not the case going forward due to recent developments with inflation. Monetary policy going forward is going to be more contractionary. In mid-March, we saw a 25 basis point or 0.25% hike in the federal funds rate. And then the Federal Reserve also expressed interest in additional rate hikes at each of their meetings throughout the year. Just about 15, 20 minutes ago, we received a notification from the Wall Street Journal that they're planning a 50 basis point hike in May. And that seems to be the trend going forward. We may see more 50 basis point hikes rather than 25 basis points. And also, so the graph you see on the screen there is the market implied path of federal funds rate. So as you can see, in the middle of 2021, many people were expecting the federal funds rate to increase, but only to about 125 basis points over the course of 3 or 4 years. That has changed as of February 2022. We're expecting as high as 2% for the federal funds rate as early as late 2022 or early 2023. And changes in monetary policy also these changes in their balance sheet policy. In November of 2021, the Fed decided that they had made substantial progress towards their goals of maximum employment and stable prices. And they decided to reduce the pace of their purchases of the Treasury spec securities. In December, due to recent developments in inflation and a continued strong labor market, they decided to double these reductions. So now I'm going to talk about the recent performance of equities. On the screen here, we have a 3-year comparison between two key indexes, the S&P 500, which is the top 500 stocks in the United States based on market capitalization, and the EFA index, which is an index of large cap stocks from developed countries, excluding the United States and Canada. As I mentioned before, a lot of stimulus money coming back into the economy, a lot of people receiving stimulus checks. Many people use that money to reinvest into the stock market. I was lucky enough to be able to do that with most of mine. I know a lot of people did as well. And we can see that the S&P 500 is up 94% since the low point of the pandemic, which is March 23rd, 2020. It's up about 9% over 1 year. Similarly, the EFA index is up about 54% since that low point in March, and it's actually down 9%. So as you can see, a major rebound for stocks following the low point of the pandemic.
All right, so there are also a lot of interesting things happening in the bond market right now. You can see there on the right, the performance of bonds from 2005 to 2022, just April. And you can see its performance has been basically flat. And that's been a lot of because of what's happened in the past year. If we zoom in here from April 21 to April 2022, you can see it's been a really, really tough year for fixed income. They're down about 9% in that time period. They're actually one of the worst drawdowns in history for bonds. Now, why is that? Well, it's a lot of what we just talked about, and mainly the interest rate hikes. Bond prices and interest rates are inversely correlated. So when interest rates go up, bond prices are going to go down. And like Drew talked about, the Federal Reserve stopped buying as many bonds. There's a lot less demand for them as well. And now that we've set the stage of the macro environment, I'm going to hand it off to Sean, and he's going to go over our high-level portfolio allocations.
Thanks, Andrew. So if you notice on the chart, the numbers under like buy and hold, value, asset class, momentum, and hedge, those are the numbers where we'd like those numbers to be as a part of our IPS statement. The circle chart is how they actually are. As you can see, our buy and hold strategy is less funded, whereas our hedge strategy is more funded. This is not necessarily a bad thing, just because we're having punch our IPS. Currently, we hold a lot of cash, which we're looking to spend very soon on different assets. So this is the buy and hold asset class strategy. This is your typical traditional strategy that financial planners will have for investors. In the Eagle Fund, we rebalance this annually in the fall semester, and the buy and hold strategy has asset classes such as real estate, stocks, bonds, and commodities. Value. So our value strategy, this buy and hold value strategy, attempts to secure investments that are low cost. We believe that they'll be undervalued by the market. So our hope is that there'll be some form of mean reversion, or the market will correct the price on those investments that are currently undervalued for the benefit of our overall portfolio. A second part of our value strategy is the acquires multiple, which we employ a basket approach. And this basket approach is essentially buying 20 or 30 stocks that fulfill a certain criteria. And this criteria is enterprise value, which is the total value of the business, divided by earnings before interest and taxes.
So the next strategy we're going to be talking about is the asset class momentum strategy. And this strategy is based on research by our faculty advisor, Dr. Brad Andrew. And this strategy finds the best performing 3 asset classes out of 10 possible asset classes based on a 6-month look back period. It is adjusted once a month to find the top 3 performers. And if one of the top 3 performers falls below the 10-month moving average, it goes to cash. So currently our top 3 performing asset classes in the portfolio are commodities, value stocks, and cash. And asset class investment strategy takes advantage of behavioral biases such as confirmation bias, recency bias, and herding. And herding is especially interesting in the momentum strategy because sometimes you'll hear about stocks or asset classes that get hot and people flock to those asset classes. And we're able to capture the momentum created by the people flocking to those asset classes. And vice versa is also true. People leaving an asset class in large amounts and herds, and we're able to get out of that asset class before the losses occur.
All right, the last strategy that I'm going to talk about that we use in the Eagle Fund is the hedge portion of our portfolio. So the hedge strategy that we use, it basically just aims to limit downside within the fund, reduce volatility and downsides that harm compound growth, and also protects against unforeseen market changes or market events. So ideally, in a world, if the hedge strategy of our portfolio is going down, that means that the market is overperforming. But if it's going up, that means that the market is underperforming. So, and we also rebalance this every 3rd week of the fall semester. So what do we hold in the hedge strategy? So this constitutes right now for 21% of the total portfolio. And right now we have 15% of it in cash and short-term bonds, which is BGSH and cash in the graphic to the right. WFC and VAC are Wells Fargo and Bank of America preferred shares respectively. And then the last 6% goes into our tail risk ETF, which is essentially like buying insurance on the portfolio because it's inversely correlated to the S&P 500.
Okay, so I'm going to talk about the fund updates real quick before we move forward. So regarding any transactions, we do have scheduled rebalancing, which as you've seen from what other managers have talked about, that usually does take place in the 3rd week in the fall semester. So during those rebalancing schedules, we also have trimmed Apple this past semester, and we also have sold TBF. We haven't had any discretionary buys, but as Sean mentioned earlier, we do have a fair amount more money in cash, so we are going to be making purchases soon. In regards to policy, we have revised our IPS statement or our investment policy statement, and now we have included the ESG policy from last year in it. So in regards to studies, we have been going over diversification strategies given the atypical macro environment which Andrew went over earlier, and we've been setting up conference calls with outside funds, which we will get onto next. So our investment policy statement, so what is an IPS? An investment policy statement is just a document between investors and an investment manager that basically goes over the rules and guidelines for how you're supposed to invest the money. This is helpful for the Eagle Fund because since the initial fund was started with a donation, there are certain rules and guidelines that we do have to follow. So 3 big things that ours includes is 1, over breaks, the portfolio managers are responsible for managing the fund. 2, if we do ever want to change anything in our IPS, we do have to have a majority vote, and our instructor does have veto power during that. And then 3, all money that is, any proceeds from the Eagle Fund are reinvested, so we're not like personally profiting for it or anything. And then the ESG policy was added to the IPS, and that stands for the environmental, social, and governance.
So as Ryan mentioned, we've been studying diversification, various strategies around diversification. Historically speaking, bonds have provided very effective diversification for stocks. They're typically uncorrelated to stocks. Prior to the 2007 financial crisis, 10-year treasury yields were around 4 to 5%, whereas inflation was around 2 to 3%. So if you held bonds at that time, you would get positive real return of around 2 to 3%. That's not necessarily the case anymore. Current bond yields are very low. Current bond yields are an excellent predictor upon returns going forward. Considering that these predicted returns are low and expected inflation over the next several years right now very high. bonds, it's not unreasonable to assume that bonds will have negative returns over the next several years. So based on some of the readings that we've done throughout the semester, we've been exploring various strategies that give us a higher allocation of equity while still providing the downside protection that bonds don't. So we're going to talk about a few of the specific products and strategies that we looked at in the next slide.
Yeah, so one of the first things that we did was we did set up a conference call with Standpoint, and we wanted to talk to them about their multi-asset fund, or Remix, as it says. So Remix is an all-weather approach that uses systematic macro trend following, and that is also combined with a large holding in global equities as a diversifier. The whole idea is that they'll have an 80% upside capture and a 40% downside capture, so that there's stable returns in a wide range of potential economic conditions. It's a passive approach, and essentially you're just kind of supposed to let it sit there. So we did have questions with this in regards to the strategy, but the two main concerns that we had is, one, it's a mutual fund, so we wanted to get a better understanding of the fees and to see if it really was worth it. And our second concern was, we were researching the fund in class one day, and we were brought it to our attention that they have something called a subsidiary, in quotations, and basically it's a place where they can hold, in the Cayman Islands, where they can hold 25% of their holdings for any given year. And that sounded really fishy. So we wanted to investigate that.
So we also took a look at another company called Simplify. Actually, prior to the Standpoint conference call that we had, we were interested in their interest rate hedge ETF, given that interest rates are going to be rising over the course of the year. And I was assigned the task of calling Simplify and meeting with somebody and kind of figuring out what the strategy behind the product was, and finding out more about the product. And what we discovered was that it was essentially insurance against rising interest rates and volatility within the bond market. And it was designed primarily for portfolios with significant exposure to fixed income. This isn't something that the Eagle Fund really has. We have very limited investments in fixed income. So we kind of decided that this wasn't something that would be a part of our portfolio. However, from that meeting, we also got some information about a few of their other products. So we took a look at their equity downside and two-tail convexity products. SPD is their downside convexity product. It essentially protects against unforeseen market declines, specifically for the S&P 500. And then we have two-tail convexity products we are interested in, SPYC or Spicy and QQC. Spicy is, again, for the S&P 500. It protects against unforeseen market declines. However, it also aims to capture the benefit of market rises without the additional risk. And QQC is the same exact thing, except for NASDAQ instead of the S&P 500. Both of these products underperform under normal market conditions, but they are designed to outperform if the market is down a bunch or up a bunch. And as those declines or increases get more severe, the return on these products increases.
What a perfect way to transition into a pretty interesting asset class that we also found out during the semester. So now I'm going to talk about Series I Treasury bonds. So basically, a Series I bond or an I bond is a 30-year Treasury bond that each person can purchase up to $10,000 annually. Basically, the thing I found out yesterday is a person can buy $10,000 for themselves, and then if they own a business, they can also purchase another $10,000 within the business. So then they can also purchase another $5,000 with their tax return. So then the idea behind a Series I bond is basically it pays an inflation-adjusted interest rate that resets every 6 months, and the rate will never go below zero. So right now, currently, they're sitting at 7.12%, but on May 1st, it's going to reset, and it's an estimated 9.62% until November 1st, and that rate is locked in. However, there are downsides, so you can't sell an I bond for a whole year. Secondly, if you cash them between years 1 and 5 maturity, you're gonna lose a 3-month interest penalty. And lastly, we can't purchase it in the Eagle Fund because we are a non-taxable account and we don't have a social security number tied into our account. So now we're going to pass this to Andrew and we're going to talk about the performance.
So the big question, how has the Eagle Fund done in the past year? Well, since we gave our update last semester or last year, the Eagle funds returned 58 basis points. We beat our benchmark. Our benchmark is 90% global equity and 10% composite bonds. So it's a pretty diversified benchmark, but the benchmark's been just under 1%, negative 1% returns. And so that means we outperformed by 173 basis points, which is pretty good. We feel pretty happy with where we're positioned right now, given the cash we've had. You can see the Eagle funds really traded sideways over the past year. We haven't had any drawdowns. We feel comfortable making some moves in the near future. So thank you, and we'll take any questions you have now.
So I have a series of questions. What is the total size of the fund right now?
Just under $250,000.
Under $250,000.
Yes.
Ever since 2007, when it
Yes.
started?
It started with $100,000, yes.
All right. So how do you compare your long-term performance? Have we not been passive, actively managing the money?
That's a good question. We probably underperformed the market in that time frame, but it's not the same educational opportunity as you.
Good response. I expect nothing less. Now, here's a question, Dan. Can you go back to a couple slides, maybe the last slide that you would, when you summarize? Yeah. So, but we tend to overly focus on the short-term performance, right?
Sure.
So now, do you ever consider like over rebalancing a thing in your strategies?
So the portfolio weights are set in the IPS, and those can be changed based on the portfolio managers of that year. So I believe we updated the portfolio weights 2 years ago when it was 3 of us, and those are the weights we've used going forward to rebalance every semester. So if portfolio managers had an idea of what they wanted to change those weights to, they could vote on that and change the portfolio weights.
And then the follow-up question would be, so is for example, the third week of fall semester where you adjust the strategy, was that timing determined by the convenience of the semester, or there's a belief that the third week of fall semester is particularly appealing for market reasons?
No, you nailed it. It's just the convenience of the. Is it?
I think it's the week after drop ad too.
It has nothing to do with investing. It's just we're all together. We know who's there.
Understood. So final question. For the momentum strategy, that's adjusted every month, correct?
Yes.
Now, so since I understand the momentum idea, but would it be also true that it might be too soon to adjust the momentum so that you may have to give up the benefit too quickly, perhaps?
Well, if it falls below our hard fast, like 10-month moving average rule, then we'll just convert it to cash and look for the next top 3 performers.
So I assume that you have a lot of cash, because maybe I've missed the slide. How big is the percentage of cash right now in your portfolio?
It's 15% of the total portfolio right now.
Do you expect to grow it?
It's 50% of our hedge strategy right now, but we're going to pull out of the hedge strategy and rebalance it probably in the buy and hold.
Got it.
It's 18,000 of cash. With it.
Okay, so going back to the performance slide again. There was a moment recently where you got ahead, right?
Sure.
Was there something to attribute to that? And you probably said it at some point during all the presentations, but if you could recap what happened in that moment to allow you to get ahead.
Sure. So, I mean, what we've talked about, our benchmark's 90% global equity and 10% bonds. And as you saw earlier in the presentation, bonds have had a really tough start to the year. And we don't have any fixed income or very little. So a lot of that recent performance has been just a drop in bond prices. And we don't have any, we've been pretty steady, pretty sideways through the year, so.
I have a question about the larger significance. I love this. I like checking in with the Eagle Fund every year, LAS, so thanks for that. Really good job. I'm curious how do you become a fund manager of the Eagle Fund? Are you coming from a specific class? Like, and then how do you, like, who determines what the next group is? This about, I'm curious about the logistics of it.
Yeah, so there's a series of, it's called portfolio management, a series of classes. It's 1 through 5 or 4, I believe. And you start being a manager once you get to portfolio management 2. And then from there, all of us are at different levels. I believe I'm in portfolio management 2 technically. But you can stay in the fund until you finish.
That's just if you're in the class.
Yeah.
So can I follow up on that?
Red Andrew needs to like you, right?
What if somebody is bad at managing the portfolio, but they happen to register for the class? How do you internally handle it?
So
How do you come to group consensus?
you are required to know some things real quick. You can't just pick a class, you know, at least an idea of strategies going into it, and then obviously build that knowledge as you continue to take the portfolio management skills.
To compensate for that, you are required to take financial analysis, which is the semester before you take the fund management 1, and that's also with BA. You can also take investing in your future with Wei Chun, if you want to discuss before. But essentially, you come in with a good idea of how to invest, you know, the different asset classes and their characteristics before you drop into this course. And even then, like, I mean, I've learned quite a bit just from, I'm in portfolio management 2 right now. I've learned quite a bit in the past semester about actually handling the fund, what we actually do on a day-to-day basis.
So what are your 3-year, 5-year?
We do not. Just because continuity between fund managers is not the best. That's a great question, and I'd love to have that information, but it really depends on each group that kind of comes through.
And then what percentage of the fund is hedged?
So right now it's currently 21%. So that's because of the amount of cash we're holding right now.
That includes the cash?
Yeah. Yeah, it's 50% cash right now in the hedge strategy. Because of the hedge strategy, we actually performed pretty well in 2020 because of the COVID pandemic and everything. But right now we're trying to figure out where we want to put that cash in the buy and hold and what it needs to go into.
I'm just curious about what your learning has been through this year. So not all 6 of you need to respond, but I mean, if you were to point to some significant learning moments in doing this work, could a couple of you comment on some aha moments relative to investment strategy?
Yeah, I think like just going in from the beginning that you just think, okay, stocks and bonds, 90-20, 80, or 90-10, 80-20, and that's just how you manage a portfolio. But I think BA really challenges you to look at different diversification strategies and things that you don't normally see unless you're really in the finance industry, if you're really working and managing a portfolio.
Yeah, just to second that, we've learned that bonds are becoming increasingly less effective as diversifiers for stocks. I would say that's probably the most important point. Really just learning about new types of diversification strategies that might provide the same effect that bonds do, just, you know, within equity instead of fixed income.
Yeah, I mean, and even adding more onto the bonds, one of the funny things that we discuss, we can't even get them for the Eagle Fund, as Bob was mentioned, but we really got a kick out of the I bonds. Whenever BA first brought it up, it seemed to be a really cool investment, and none of us have heard of it, so if it wasn't for him, like we honestly would have no idea. But it's just a really cool investment, and I had no idea of I bonds in general, and also just about all these, we've been talking about all these crazy diversification strategies to kind of replace bonds and this portfolio, and also just in any general
One thing that was surprising was that commodities are really hot right now because the inflation rate is really high. And second to that, REITs, real estate investments are second to that. And what's surprising about commodities, because from reading one of the texts from investment analysis, I was very skeptical of commodities because there's so much of a up and down, they're very like volatile because you have to time the market correctly. However, in a momentum strategy, I think that commodities are very advantageous to deal with inflation.
Taking it on the negative side, what do you, looking back on the past year, what is something that you did or did not do that you wish you had done or not done? And looking in the rearview mirror, how do you think you might have avoided making that decision?
So one of the things we did in the past year is right at the beginning of the year is we sold TBF, which is a short, long-term bond position. That would have turned out to be a really good investment this year. The main reason we had TBF in the portfolio was as a hedge to Apple. And we had a really large position in Apple. It was our largest position, actually, I believe it was 15% of the portfolio. And so Apple, we determined was correlated with rising interest rates and its performance. So we tried to hedge that with a short position in bonds. And when we trimmed Apple, we also got rid of the hedge position. Which was the right thing to do, but looking back, it would have been nice to have given the environment.
Pollard? One mention Pollard, we have that was good.
All right. So last year we purchased a company called Pollard Banknote. So basically they were a Canadian company that ran casinos and printed lottery tickets, and it didn't turn out so well. And looking back, we should have probably sold it a lot sooner, but due to the nature of the fund and our IPS, we didn't have that opportunity.
So do you think there's something to be done in your IPS or procedurally to allow you to make a different decision in the future? There's something to be learned from
that? I agree. I mean, the reason why it's set up the way it is in the IPS is so everything can logistically work from year to year, but at the same time, we could put more time and effort towards rebalancing, but at the same time, I think it would get a little bit too messy and too actively managed at that point.
Put target prices, stop losses.
No sauce.
The stops and the target price.
Nope.
Alrighty. Oh, no. Okay, right back at it. Thank you all for coming. And if you have any questions you want to personally ask before the managers, please come on down. Should be happy to answer any questions you have. All right, thank you. Thank you very much.